Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. Today we're embarking on a real deep dive. We've gathered a collection of major headlines from sources like CNBC and Reuters, all heading around today, September 9th, 2025. Our mission, as always, is to cut through that noise, cover the crucial insights, connect the dots between stories that might seem separate at first glance, and really give you a clear picture of what's genuinely moving the markets and, well, the global economy right now. And believe me, we've got some fascinating paradoxes to explore today. Like, how can stocks hit record highs right after a, frankly, pretty gloomy jobs report? We'll also unpack that complex dance between AI innovation, which is just booming, the impact of trade policies, and of course, those critical central bank decisions.
It's really striking, isn't it, how all these headlines, from cutting-edge tech like AI all the way to global trade disputes, they aren't just isolated events. They're absolutely threads in a much larger tapestry. We're seeing a period of intense, rapid economic transformation, and we're here to help you move beyond just the what happened to understanding the why it matters and, crucially, what it could mean for you and your decisions, whether you're an investor, a business leader, or just someone trying to stay informed.
Okay, let's unpack this then. And where better to start than the AI industry? I mean, it is just exploding with activity. Some massive headlines here. First up, the French AI firm Mistral. Its valuation just more than doubled. We're talking a whopping $14 billion. Now, CNBC reported this surge was driven by a huge 1.7 billion euro funding round. And the big player here, the Dutch chip giant ASML, they put in 1.3 billion euros for an 11% stake.
Yeah, and what's really fascinating here is ASML's move. It's quite strategic. This isn't just throwing money at AI. It's being called a first-of-its-kind partnership. It feels like a very clear signal, right? Directly supporting the European Union's big push for its own sort of sovereign AI movement, trying to lessen that dependency on Silicon Valley. And if you connect that to the broader picture with all the protectionist trade stuff happening globally, well, this kind of European collaboration makes a lot of sense. ASML CFO Roger Dassen is even joining Mistral's strategic committee board, so it's deep involvement. And Mistral itself, well, they're positioned as Europe's main rival to OpenAI. They're building these large language models, LLMs, the tech behind sophisticated AI tasks. They've just launched a new reasoning model, too, apparently great at mathematics and great at coding.
Right, but still a way to go to catch OpenAI's, $500 billion valuation?
Oh, absolutely. A huge gap.
Yeah.
But the direction of travel for European AI is clear.
And it's not just Mistral, is it? The investment is flowing everywhere in AI. Nebius, an AI infrastructure firm, saw its stocks jump 51% in pre-market trading. That was off the back of a massive deal with Microsoft. Multi-year, multi-billion dollars.
$19.4 billion, wasn't it?
Exactly. $19.4 billion for Nebius to provide cloud computing power. Specifically, those GPUs, the graphics processing units that you absolutely need for training these huge AI models.
And this just hammers home the point about the sheer scale of demand for computing power in the AI space. It's immense. Which brings us to a really crucial question. What are the broader economic ripples from this AI frenzy? You mentioned NVIDIA earlier. Their CFO, Colette Kress, she's projecting something like $3 to $4 trillion in AI infrastructure spending by the end of the decade. Trillion. That kind of money, I mean, it obviously fuels growth. It fuels the tech rallies we're seeing. But here's a twist, and it's a big one. While AI is driving all this, we're also seeing reports like Salesforce cutting 4,000 jobs, Klarna shrinking its workforce by 40%, and they're directly blaming AI for those cuts. Efficiency gains, they call it. So it's this complex sort of dual impact, isn't it? Growth on one hand, displacement on the other. It suggests a major restructuring of the economy and the labor market is underway. And for you listening, this really signals a shift, not just in which companies are winning, but potentially in what skills are most valuable. It's something to really think about. How do you leverage AI rather than get disrupted by it?
And the politics are getting tangled up in this, too. CNBC mentioned NVIDIA CEO Jensen Huang is apparently going to be with President Trump on that UK state visit next week.
Interesting timing.
Yeah, it just highlights how these chip makers are navigating, tricky political relationships, especially with all the talk about China chip licenses still rumbling on. Okay. Shifting gears slightly, let's talk global markets and this head-scratcher you mentioned earlier. U.S. stocks hitting record highs on Monday, the NASDAQ composite included. This was despite that, dismal August jobs report. Only 22,000 non-farm payrolls added. Unemployment up to 4.3%, a near four-year high. Normally, weak jobs equals bad news for stocks, but not this time. We saw tech rallying hard: Broadcom, NVIDIA, Amazon, Microsoft. How do we square that circle?
It seems counterintuitive, I agree. But if you connect the dots, One dominant explanation floating around, covered by various sources, is the market's strong bet on Federal Reserve rate cuts. Traders are pricing in, an 88% chance of a quarter-point cut at the Fed's meeting on September 17th, and there's even a small sort of outside chance, about 12% being priced in for a bigger half-point cut. So the market is essentially anticipating easier money, lower borrowing costs, and that tends to boost sentiment, particularly for those growth-oriented tech stocks. Bad news on jobs becomes good news for rates, basically.
But the Fed has that tricky balancing act, right? It's not just about jobs. They have that dual mandate, stable prices and maximum employment.
Exactly. That's the core of the challenge right now. How do they manage a clearly weakening labor market against inflation that might still be, sticky? We're all waiting for the producer price index on Wednesday, the big one, the consumer price index on Thursday. Those numbers will be critical. Economists, according to CNBC, they expect core CPI to remain above the Fed's 2% target. So you see the dilemma. As economist Torsten Sloss pointed out, the Fed's two goals are basically in conflict right now. Stable prices versus full employment. It makes their policy decisions incredibly delicate. And those decisions, they directly impact your borrowing costs, your investments, the whole economic climate, really.
Yeah.
It's a real tightrope walk.
Okay, elsewhere in the markets, gold seems to be having a moment, a new record high, according to Yahoo Finance. What's fueling that?
It is shining bright, yes. A new all-time high, over $3,693 an ounce. There are several factors converging here, I think. Optimism about those potential rate cuts is definitely part of it. Gold often does well when interest rates, or the expectation of them, fall, as it lowers the opportunity cost of holding it. But it's more than that. We're seeing continued buying by central banks around the world. They seem to be diversifying reserves. Plus, there's stronger haven demand. Ongoing geopolitical tensions tend to push investors towards assets seen as safe. And interestingly, some analysts are even pointing to President Trump's tariff regime and his past criticisms of the Fed's independence as factors contributing to gold's longer-term rally over the last 3 years. It signaled this broader sense of caution, maybe. A search for stability in what feels like a pretty uncertain world. Tells you investors are looking for something tangible.
Right. Now let's look across the Pacific. Asia-Pacific markets were described as a mixed bag yesterday by CNBC. Political shifts seem to be a big driver there.
That's a very good read on it. Politics were definitely front and center. Take Japan's Nikkei 225. It hit a record high earlier in the day, then reversed to close down 0.42%. And that followed Prime Minister Shigeru Ishiba's resignation. What's interesting now is investors seem to be betting on new fiscal stimulus from whoever comes next. Julius Baer is already forecasting upside to 46,000 for the Nikkei in 12 months.
Setting on change, then?
Pretty much. Elsewhere, it really was mixed. South Korea's Kospi gained, Australia's S&P SX 200 slid, Hong Kong's Hang Seng was up, but Indonesia's Jakarta Composite Index fell, again, due to political changes. The president dismissed the finance minister there. So yeah, it really underscores how, even with global forces at play, local political events and stability, or the lack of it, can have a really immediate and sometimes powerful impact on markets right across Asia.
Okay, let's move to some corporate maneuvers. This is where it gets interesting for investors specifically. Jim Cramer highlighted the newest companies joining the S&P 500, AppLovin, Robinhood, and Core Group. They're set to join on September 22nd. And Cramer's main point, which applies to all three really, is that getting into the S&P 500 forces index funds to buy your stock. It creates this sort of built-in demand.
It's a huge deal for companies, a structural boost, essentially.
Right. So for AppLovin, the digital ad tech firm, he called it red hot. Huge gains already. He expects some profit-taking maybe, but suggests buying on weakness. Robinhood, the trading platform, he sees as a juggernaut, reinventing retail brokerage, expanding into options, crypto, retirement, credit cards, bullish on that wealth transfer to younger folks. Again, expects selling maybe, buy on weakness. And then EMC Group, engineering and infrastructure. Less hype, maybe, but an attractive story. He called that one a buy now, benefiting from the data center boom. And interestingly, the reshoring of semiconductor and pharma plants tied back to those Trump administration tariffs.
That S&P inclusion is just a massive validation, isn't it? It basically guarantees a certain level of institutional buying, a real tailwind.
Definitely something for investors to watch there. Now, also on the corporate front, Apple. Big iPhone event today. What's the buzz?
Yeah, the annual September event, the focus seems to be on design and cameras this year. We're expecting maybe an iPhone 17 Air Slimmer, single wide-angle camera, maybe smaller battery, focus on portability perhaps. And then the iPhone 17 Pros, upgraded telephoto lenses are rumored, and a redesigned camera bump. So continued push on the high-end photography side. Apple stock has been, a bit mixed this year, down about 5% year to date. but it's had a decent run lately, up 17% in the last 3 months. So maybe some renewed confidence heading into this launch.
Hmm. This talk of individual stocks raises a broader point about market sentiment right now, because we are seeing some really stark contrasts between different sectors, aren't we?
We absolutely are. It's quite divergent. On one side, you've got the big banks, JP Morgan, American Express, Citi, Goldman, Morgan Stanley. They're hitting new all-time highs or multi-year highs, as CNBC pointed out. That could be down to resilience in this rate environment, maybe strong consumer spending in some areas, who knows. But then, on the other side, look at Starbucks. Down since the new CEO took over a year ago. Or Lululemon just hit a new low, down, 36% in 3 months. That contrast isn't just noise. It gives you a really nuanced view of where investors see value or risk right now.
Yeah.
It highlights shifts in consumer habits, maybe, or specific industry headwinds affecting different companies very differently. Fascinating divergence. Okay, and for the crypto watchers out there, big news from Reuters. Gemini, the exchange founded by the Winklevoss twins.
They're planning a New York listing this week, and they've tapped NASDAQ, the exchange operator, as a strategic investor. That feels significant. Gemini could raise up to $317 million, and NASDAQ itself is buying $50 million in shares. This is despite Gemini reporting recent net losses, though they hold $21 billion in assets. Massive lifetime trading volume.
It is significant, and it kind of mirrors other moves we're seeing. South Korean fintech Toss, for example, also has big plans. Global Push, starting in Australia, wants to issue a stablecoin, eyeing a U.S. listing in 2026 with a potential $10–15 billion valuation. What this signals, I think, is this continued sort of institutional embrace or validation of the crypto market. Yes, it's volatile, we all know that, but major players are clearly making long-term bets on crypto becoming more mainstream, maybe hoping for more regulatory clarity down the line. These aren't just isolated IPOs. They point to a maturing industry, perhaps.
Okay, let's turn finally to global trade, because things here are getting, well, seriously complicated. A huge story today, reported by CNBC. The U.S. government might be facing a massive bill because of President Trump's tariffs.
This is one about the court rulings, right?
Exactly. 2 federal courts have ruled many of those Trump-era tariffs were actually illegal. It's now heading for a Supreme Court fight. And the stakes, they are enormous. Treasury Secretary Scott Bessent warned that if the Supreme Court agrees with the lower courts, the U.S. government could be on the hook for refunds to importers totaling anywhere from $750 billion up to potentially $1 trillion.
$1 trillion. That's just a staggering number.
Yeah.
And this is critical for businesses, but also for you as consumers, because the sheer uncertainty around this is already hitting supply chains. Reuters noted U.S. container imports from China were down almost 11% in August. The whole year-end outlook for imports looks dimmer because of these ongoing trade frictions. Companies are basically being told, keep meticulous records just in case they can file for refunds later. And get this, some third-party firms are actually buying the rights to these potential refunds from importers, paying pennies on the dollar now, betting on how the Supreme Court will rule. That tells you the scale of the financial risk and, I guess, the speculative opportunity involved.
Wow. And it's not just about those past tariffs either. New ones are already causing ripples. President Trump was seen with the Rolex CEO at the U.S. Open recently.
Oh, that picture.
Just weeks after his administration slapped a new 39% tariff on Switzerland. CNBC reported that analysts pretty much expect Swiss watchmakers will have to hike their prices because of this. Maybe they had a temporary buffer from shipping extra stock beforehand, but price rises seem inevitable. Bad news if you were saving for a Rolex.
Directly hitting the consumer there.
Yeah. And beyond the U.S., major trade talks are happening elsewhere. Reuters reports India and the EU are in potentially decisive talks this week. They're trying to hash out a trade deal by year-end. India's looking for partnerships, especially after Trump doubled tariffs on their goods to 50% because of their Russian oil purchases. But there are sticking points with the EU. India doesn't want to give ground on agriculture or dairy. The EU wants more access for cars and alcohol. And there's friction over India buying discounted Russian oil, plus that controversial EU carbon border tax, which India sees as just a hidden trade barrier.
It really does highlight just how complex these modern trade deals are. You've got economic interests clashing with geopolitics, environmental policy. It's a tangle. And it's not just India-EU. Bloomberg reported the U.S. and South Korea are deadlocked over a $350 billion investment fund that was part of their trade deal. Seoul says it can't accept the same terms Japan got. That deadlock could even threaten a shipbuilding partnership. We're also seeing, according to Reuters, Vietnam's exports to the U.S. falling because of new 20% tariffs there. And Chinese imports are down too, amid accusations China is transshipping goods through Vietnam to avoid tariffs. All these examples taken together just paint a picture of how interconnected, but also how fragile global trade relationships seem right now. Political shifts, tariff decisions, they have immediate, real-world economic consequences for companies and ultimately for you as consumers and investors. It affects prices, availability, everything.
So let's try to wrap this up. What does this all mean for you, our well-informed listener? We've navigated a pretty complex landscape today. AI driving huge valuations, but also job fears. Central banks walking that tightrope between inflation and a weakening job market. Global trade tangled in tariffs, tricky negotiations, shifting alliances.
Indeed. I think if there's one underlying theme across all these headlines, it's rapid change, coupled with, frankly, inherent uncertainty. Whether we're talking about the transformative power of AI, the Fed's next interest rate move, or the future shape of international trade agreements, the decisions being made right now, today, they will absolutely echo in your investments, your job, your everyday life tomorrow.
So here's a thought to leave you with. With the sheer volume and speed of information, everything we've just discussed, how much of what we perceive as market fear or maybe excitement is actually grounded in solid long-term fundamentals, versus how much is just speculative betting on short-term policy changes like Fed cuts or the disruptive potential of new tech like AI? And maybe more importantly, what does that distinction mean for your own strategy as you navigate this constantly evolving economic world?
That's a really provocative question. Definitely food for thought, looking beyond the immediate noise.
And with that, we'll see you all tomorrow morning with new headlines from major financial magazines.